What is the non-resident capital gains tax rate and when do you need to pay it? That's a great question, especially when you're selling a UK property. Check out this video as Louise and I discuss this very subject. Hopefully everyone can see it. There we go. Donald has asked a question on YouTube. I love this feature. I've got to be honest. This is my new toy. I'm doing YouTube live every night. So Donald, as you can see there, Donald's asked a question. As an expat, capital gains tax declaration for sale UK property, which has been let out for 14 years. So let's put this into context. So you had a buy-to-let property
here in the
UK, and then you leave the UK, and then you think about selling the property. Really interesting aspects, something called NRCGT, which stands for
non-resident capital gains tax.
Right. And the reason why it's interesting is because there are three valuations. And I'm going to go with the two because it's just easy with the two.
Okay.
But there are two methodologies that I kind of use quite a lot when we're doing non-resident capital gains tax, because typically capital gains tax is based on the sales price less the purchase price will give you the gain. You get this annual exemption allowance, and then you have a net gain, which you're taxed on. And give you a quick example, you could have a sales price of £100,000. You bought it for £50,000. You had a gain of £50,000, and then you get your £12,300 allowance deducted as well. But just keeping with the 100,000 and 50,000 to give you the 50,000 gain. There's a lot of numbers here, so I'll restate that all. £100,000 worth of sales.
I'm surprised you've not typed it in already.
I don't. £100,000 worth of sales. £50,000 is the original purchase price, and then £50,000 gain. What's really interesting about this is that you can take the April 2015 date for residential property. It's slightly different for commercial property. Do you know what the date is for the commercial property?
Yes, it's 1 year later.
Yeah, 16, isn't it?
6th of April 2016.
So let's imagine that you bought it for £50,000 way back when. And in Donald's case, I think it's about 14 years ago. But let's imagine now that the valuation as of 2015 was £75,000. All of a sudden, things change because you have the sales price of £100,000. That doesn't change, of course. But the purchase price, the deemed cost of that property, will no longer be the £50,000 that you originally bought it at, but it'll be at the revaluation of April 2015 of £75,000. So your gain is now just £25,000. You're smiling. Have I done something wrong here?
No. I was just about to say there'll be probably a lot of people out there going, oh, does that mean I can revalue my property and I don't have to pay the capital gains tax I thought I was going to? I'm sorry to be the bearer of bad news and a real humbug.
Is that kind of a woe there and a horse there?
Yeah, whoa there.
Right.
But this only works non-resident at the time you sell the asset and remains so for a minimum of 5 years. Okay. So sorry, this is not a get out of jail free card, so to speak, for everybody when it comes to tax treatment of capital gains. It only works if you're not resident at the time you sell. And like I say, you're not resident for a minimum of 5 UK tax years.
Yeah, there is a double whammy here because obviously we're saying how someone can reduce their tax liability. But interesting enough, we had a client that was moved to a different country, and the way that they calculate capital gains tax was income tax. So pretty much what Rishi Sunak was trying to explore, and he mentioned nothing in the last budget.
Did you not know Rishi Sunak was wanting to simplify capital gains tax?
Well.
Tax?
Did you not know that? He basically, I'm not having that. So I'm a Rishi fan, not having that at all.
Hashtag Louise for president.
Yeah, president.
Absolutely.
One country.
I'm taking over the lot.
So that's why you got the Democratic jacket today.
How dare you?
Right. So from that side of things, the idea behind it is that if you are moving countries and you're selling property, albeit the NRCGT or non-resident capital gains tax could be beneficial from a UK perspective, it could scupper you in the country that you're living in. Because places like US, Australia, many other countries, even Spain, will tax you on your worldwide income and your worldwide gains. So if you're selling property, not only you've got to think about the UK tax, you've got to also think about the tax and the country you're in. So, Donald, I don't know what country you're in, but do research because it may be a position of going, well, yeah, that's great. I've come onto this show and I've saved some UK tax. But actually, Donald, you do need to look at where you are now, and is there any tax implications of selling that UK asset?
Yeah.
Anything
if
to
you're
add
in
on
Hong
that?
Kong and Kuwait, amazing. I do have a couple of things, if I may.
Please do.
These rules, and you're probably saying to yourself now, Donald, oh, darn it, I didn't get a valuation on the 6th of April 2015. Why on earth didn't I do that to know what the value of the asset is? The great news is that if you work with RICS surveyors, they can do a calculation to work backwards to establish what the value of the asset was at that time. But you can also do what's called a... oh gosh, my brain's gone dead. What's it called? Where you just do the average across. I think it's called an averaging election.
It is averaging election.
Whereby you look at the full period of time you've owned the asset, and you look at the time, the number of days, if you like, in total. And then you look at what proportion of that total time has been since the 5th of April or 6th of April 2015. And you then look at your total profit you've made at sale or loss, and then you only apply the capital gains tax calculation to the percentage of time that has transpired since the 6th of April 2015. So don't feel like, oh my goodness, had I known this, I would have got a valuation. I'm in a real mess now. I can't do that. Like I say, two options. Go to a RICS surveyor and ask them to kind of calculate backwards, and also do that net kind of calculation across the total. And here's the lovely thing. HMRC will let you apply whichever of those calculations gives you the best result for you.